Hey everybody, hey traders. 3 p.m. final hour. Let's go. Let's talk some stocks, options, futures, source, crypto. Nice to be with all of you today. See the chat light up here in just a little bit. Happy Thursday. All right, we are staring at some fresh lows of the week. We did break these lows from Tuesday, and we've had quite the move. We are down from high to low 1.77% today. High to low, that's not exactly what the market's reading because of the close yesterday. So market's reading about 1% of a sell-off. I'm going to look to see if we can get back to 5,900 today. Let's go back to 5,900, which would be a nice little attempt to thwart this little dump. This is a big level that I've been watching all week in case we had a gap fill. This is a spot where I'd like to see the bulls step back in. So here's a 15-minute time frame SPX. This is a CPI fill from January that if we are going to fill this all the way up, that gets us down to 58.40. There could be some more pressure to the downside. Obviously, we could take out these previous lows. This would have been your, trying to think here, your deep seek. I'm trying to put this all together here. We had, we had deep seek in here. Was it tariffs in here? Something. It's all like a big blur now for the last month. That was a tariff play, or not a tariff play. That was a CPI play that got us back up to the highs. I want to say that's the combo of DeepSeek, tariffs, and tariffs. CPI gets. Nope, I got that wrong. My bad. This is the 18th of December. That's Fed. This is holiday stuff. This was DeepSeek. This was tariff. This was tariff. That was CPI. There we go. All right. Hey, Tom, how are you? Tom watched my Telegram video. Hey, Christian. Papa John, what's happening? Rep says, happy Thursday? Well, I mean, depends on who you are. It's Thursday. That's at the very least. So, I mean, I do have some profit trades running this week. Costco's looking good. SMH, I took profit on Intel. I closed out. Japanese yen futures closed out. Microsoft closed out. JD is hanging in above the $40 strike point. So I get some shares called away. I've got another one rolled out into March, as long as it stays above $40. But yeah, the market is sliding. We're in the 1.7% high-low swing today. Pretty decent sell-off. Again, nasty volatility, a lot of chop this morning, but the market prevails. The slide is still coming. All this goes back to is a bunch of bar counts. If you've been following any of my sessions for the last literally 3 months, as we got into the end of the year, I was very cautious going into the end of the year. Why? Because of this little reading right here. Okay, this is a 329-day bar count, or 329 bars rather. Days wise, calendar days and bars are different, but we are overstretched. So, do I think the market could pull back? Yep, and I think it's trying. I'm looking at the market doing something along these lines, like a broadening pattern. So, I would just want to brace traders, get them ready for this potential slide. We had a bit of a hesitation at the 100 moving average, which I'll show on my other chart. But if this continues to sell off, I do think there's a buying opportunity around the 5,700 zone to be a pretty strong buying opportunity. But with the velocity in which things are falling right now, it does seem to be like run for the hills. How are we hedging? Which I am hedging. These are the trades that I'm hedging. I've got some income trades in here on XSP, income trades on SPX, income trades on ES. So my futures hedges, ES and MES are doing pretty well. I probably have over 10 grand in hedges right now. Let's see here. So let's go all hedging, and micro. So we have futures, $2,600, $1,400, $8,000. So even though today shows a down day of 25 grand, I am staring at some pretty good profits, 2,600, 1370, and 7970. So I've got about $12,000 in hedges, which does help offset some of this nastiness. I get it. Like, markets are dropping, feels like crap. Bonds are up. Did I take a huge chunk of my portfolio and put it in bonds? No. But it is actually looking decent. I mean, trading at 91.36. We're not at fresh highs, which is interesting on bonds. US 10-year yield is the same. We're not any lower. Dollar index caught a bid today. So that's going to be interesting to see how that plays out. But let's go back to the bar counts. Okay. High bar count on the S&P. It's really this simple. If you're looking for areas to buy a dip, this is what I'm playing right now. I think this is a broadening pattern. I think we're going to come back and fill. This was the election gap that did get tested. I'm going to put in a little support level there, right? So the spot that I'm watching is right around this, let's say 5750 to 5700. Now that would be like perfectly technically sound. This market just comes right down to the 200 and then rips back up. What we might end up having is some type of like, larger slide capitulation move. Maybe it overshoots the 200 first and then settles back above. And that's a better chance for the bulls to come back in. The one thing I don't feel like doing is just, option wise, I don't feel bad about taking a stab at it. I can take a nibble, I can take a bite with options, so it's defined risk. But if I just wanted to like dollar cost average there, I would put a very small amount. I would say I'm going to put like a 1K position there. That pullback would be around 8% from the previous highs, right? So we have all-time highs here on the SPX. That would be a test of around 7%. 7%. Okay, is that a bear market? No, that's correction territory. 5, 7, 10%, those are correction levels. We get into double digits, that's a steeper correction. We get over 20%, everyone's talking bear market, right? So anyway, 5750 to 5700, that's a level I'm watching on SPX. Take that into the SPY. You're looking at the 570 handle. So I would just say let's say 575 to 570. Similar numbers. XSP levels around the 570 handle. 570, I'll put same thing. 575 to 570 on XSP. NASDAQ also dropping hard. This is a lot of momentum getting dumped out of the market. This is a big rotation that's happening. NASDAQ from the all-time highs that it poked, that was a fake out. That would be a 9% correction in NASDAQ. And that looks like a 495 to 490 handle. 495 to 490 would be a level that I would be interested in maybe grabbing a dip. Okay, testing option trades. Best way for me to trade this would be something simple like waterfall income. That's an easy service. Being able to kind of pick and choose our levels, dollar cost average in, give the market some time, 30, 40, 50, 60 days, and see if we can catch, a bit of this bottoming area, right? So it's defined risk. See if the market can respond nicely. This is what makes it feel so crappy, by the way, because we have 1, 2, 3, 4, 5. We've had 5 days of selling. And it feels like the market can't do anything right. It's all selling, right? So Larry watched the video, Brian watched the video, Sam watched the video. Nice. Chris said 2 small wins today. Tough week. Yep. Willard watched the video. Greg watched the video. John watched the video. Doug watched the video. Nice. Got some Telegram followers out there, which is always awesome to see. All right. I need to see the SPX come back up to 5,900, hopefully in the next 50 minutes. I'd like to see a little bit of a buy towards the end of today, not just full flush to the downside. We've had another just late day, 1 p.m. afterwards, just a big drop. So I actually want to look and see, could this capitulate and get worse? Tomorrow's a new day, right? So yes, it absolutely could get worse. And I'm just thinking like, would it be in my best interest right now to start protecting some of my futures trades? Right now we're trading at SPY 587. I think I have a 605 by 585. Let me take a look at that one right now. SPY. I know I have a hedge in here somewhere on the SPY. So SPY, this 605 by 685 is up $550 right now. My max profit on that one, so it's a 1-to-1. I don't want to wait until the end of March. We're already trading at 587. Son of a biscuit. So my max profit would be about $1,600 or $1,700. But could I take the profit in this right now? May not be the worst thing. So this is trading for probably $10 credit or so. So that's more than 100% gain on the hedge. I could use it to go a little bit lower. If we're going to keep flushing, I guess that's the question. It's like for my hedges, I really need to let them sit and hedge and do their thing. I mean, the hedges are small risks. It's like 1/4% risk, 0.5% risk for a 1 to 2, 3% gain. Um, I need to be able to brace a little bit more for this downside if we're in fact going to continue to see more downside. A chart alarm set to 59. I'm gonna watch this. I have to watch this for the end of the day. I've got to trade in. I've got 2 trades in actually. I got a broke wing butterfly that if we get above 5,900, I'll keep the credit for 50 cents. There's also a profit trap in there that looks something like this. So if price is now down far enough that it's I guess my break even is going to be around 58.90. That's going to be my break even. But ideally, I like to see this thing around 58.95 or 5,900 would be kind of the perfect trade. So we'll see if we get there. All right, 6 red days in a row. I know it's felt like crap. I know, but is anyone like, why is this happening? I mean, I've only been talking about this for 3 months, so I'm not surprised. It's just this is what's so rough about the market is when it happens, it's just it all feels like the whole world is like, oh my god, the market's never going to go back up. That's what it always feels like. So, I mean, that's why I'm trying to point out some really key levels because there will be opportunities to buy some dips. The question we have to ask with these dips is this a dip that is going to cause, more pain where it's a dead cat bounce and then there's another flush lower? That's what we don't know, right? If this is a flush down to reposition and then the market bottoms out, getting us like some type of V bottom or reversal pattern, stock market does this a lot. Cup and handle happens a lot, right? High to low, we come back up here and then we break this level. That cup and handle would be the reason we can come back to the highs. What I'm trying to avoid is if this is happening here, right, that the bottom is not quite in, and I don't want to guess without trading something to find risk like an options trade, right? I don't want to guess. So keep an eye on this hedge right now at 566, but I know my max profit in this one is pretty large. This one can pay out about $1,500 or $1,600. If I get close to that, like $1,200, $1,300, $1,400, I'm probably going to take that trade off. This 111 trade is up a couple $100, so that's fine. This is my broken wing that's upside down a decent chunk today. I want to see if we get a move back up to 50, 58.95, 5,900 by the end of today. So I've got 45 minutes to watch on that one. Let's see here. I did this one just a little bit ago. This is bear call spreads for about 45 cents, just trying to grab a little extra income as long as price stays below 59.50, which right now that seems to be the play. So this broken wing might suck a little bit if it doesn't come back to 58.95 or 5,900. So I'm watching, but there's still time in the trade. Just don't implode, right? I don't want to see the market just dump and close red all freaking day. I mean, we have been dropping. I mean, this is a 15-minute chart. We have straight candles. 1, 2, 3, 4, 5, 6. We have 8 out of 9 candles all red since 1 o'clock. That is quite aggressive. Like, these bears are not joking around right now. There is clearly some dumping of momentum, dumping of growth, rotating into defensive, going into lower beta. That's not a surprise. So, couple ways we can approach this whole thing, right? Be aware of some of these key levels. I'll revisit these for people that have come in late. So S&P bar count, watch it. It's a 200 moving. It's a 200 exponential moving average. This is where I'd be looking for levels to kind of take some nibbles and look and see if the bull market can resume. But until then, the bears have the upper hand. We now have 5 or 6 candles in a row that have all been red, and it doesn't feel good. It's like, when's the last time we had 6 bearish candles in a row? I couldn't tell you. It's probably been years, in fact. I mean, no joke. Like, it's probably been years outside of this maybe slide here in April. This was 1, 2, 3, 4, 5. There's 6 candles in a row. Okay, so we had 6 candles in a row from a slide of around 4%. That decline in April was around 6%. Okay, so we're looking at something from these recent highs, and this momentum picks up. So, 5 or 6 candles in a row, we're down only about, 4 or 5%. That's what's crazy. It feels like absolute, run for the hills. The sky is falling. The market is broken. It's only a 4% pullback. This is why I'm saying there could be more pain ahead. In fact, just because this is a moving average with a nice little level This is only about a 7% pullback. Okay. So I'm as curious as everyone else, like, is 7% all we're going to get? Or is there more reality going on right now? Is it like, oh, we could slide and capitulate past that level and we could have this giant fall, and then the market has to basically come back out and show that the bulls are going to step in, or the market has to come up here and then base a little bit and then the bulls can step back in. But I will be looking for a bottoming pattern. If we're gonna resume trending up, there's dynamic support that I'm looking for. So anyway, that's where we're at. All right, come on, man. This thing has just been a relentless slide today. Super noisy this morning. Bear call spreads, that was the play. So we took some bear call spreads this morning and daily profit play. I added 2 more, so that'll be a couple of winners. But my broken wing is not looking too good right now. I need this thing to snap back hard to find that tag this alarm at 5,900. All right, let's see what else we got. So everyone on the same page here. A couple ways this happens, right? The market continues to drop. I wouldn't be calling the bottom anytime soon. Somewhere around these 200 moving averages, that's when I could get interested. I think that if we get kind of this purge is out of the way through now until March, and I don't know what that looks like, right? I mean, 2020, we had a 25 to 35% pullback from February to March. So the markets could get really nasty really quickly. That's always the unknown. But coming down to this 200 moving average, here's the one thing I would be watching. JNK is basically your credit spreads, right? Now this is like the treasuries between AAA, triple B, triple C. How liquid is the market? It's still pretty liquid. Like this, anytime you've seen the markets get really, really, really bearish, this instrument tanks, right? So let's go back and see. I mean, this would have been anytime in December of here's 2018. Volmageddon in 2018, this thing dropped hard. December 2018, the market dropped 20%. This thing dropped hard. COVID, this thing actually obviously dropped hard. All of 2022, this thing dropped hard. Right now, this isn't going anywhere, right? So I still think there is a fair amount of liquidity in this market where this is just a correction. This is a rotation. Money is leaving Mag 7. Money's leaving momentum. Money's leaving growth, repositioning portfolios. If everyone that was 10% weight in Mag 7 all of a sudden gained to 15, 16% weight, they're going to shave that down, take their profit. Mag 7's tipping over a little bit. That makes sense? So this happens. I will keep a close eye on this one because if we're checking this out in the next week or two and we're all the way down here with some like crash, then yeah, we're gonna have some wild and crazy times in the market. Okay. Closing the gap to 29% down. Do you think it's a good spot to get out, stop the bleeding? What are you talking about stopping the bleeding? I mean, if you're in the trade that I called with Shopify, I closed out for a small loss. I closed out for like $4 or $5 credit. I ended up taking like a $5 or $6 loss on the trade. I mean, I posted that alert on like Monday or Tuesday. So what is Shopify trading at right now? Shopify. I'm gonna have to go back and look and see what the trade was. Let's go history. Shopify. There we go. So I ended up closing out. I can't see what the trade is at right now, but I closed out for credit wise. So 16 cents minus 4.18 plus 01. Dang it. 16 cents minus 4.18 plus 01 plus 59. So I closed out for $4.60. So I took about a $6 loss on it. So I'm out of the trade. I posted that alert probably Monday. And it would have been in Telegram. It would have been in the alert section. It would have been notified on email and SMS. You're basically at break even. I mean, we had this trade in from like a 119 put. You're going to have around $8 of real value in the trade. So it's not positive, but it's not a full loss, right? That trade should still be showing like $7 or $8 of credit, which means you can take a manageable loss on the trade. Okay. All right, so we're at 58.90. We have about 40 minutes left. I'm going to check on my broken wing really quickly to see if I've got any type of profit trap that I can close out. I'm looking to stop this one from being a problem. Broken wing right now is trading for, son of a biscuit, still trading for like a 560 debit. Well, that's not going to help me much. All right, man, we need something in this 58.95, 5900. We need a nice little pullback today. Come back and find some 5900, would you? Anything greater than George, if I'm in the trade, if I was in the trade right now, I'm out. 750, 775, 790. I'm eating the loss. I'm not worried about it. I would just take the loss. That's a small loss, right? That's a small loss. It's manageable. Okay. So I'm watching SPX. If we're greater than 58.95, I start to get into a profit trap, or even up to, I'll just put a dash here, or up to 58. Nope. 58.95 to 5900. That is my profit trap. So right now price is just below it. I need to see if price will give me that little profit trap window. So I need about a 7 to 10 point move to the upside. And this is something I'm going to have to take into literally the final hour. So the next 35 minutes, I'll be watching this. Hopefully we get a nice big green candle. If the market just tanks and closes red, then I'm going to, eat some loss today on that broken wing. I'll grab, what was it, 40 cents this morning, another 45 cents in some bear call spreads. I've got some hedges in, which will help offset it. But, what a wild, this is well beyond the expected move. We have gone 113 points today. Recent averages on the S&P, so this is SPX, recent averages should be around maybe 70 to 80 points. Yeah, the daily average is 70 points. So we've gone about a 1.5 standard deviation move today. And on the week, it certainly hasn't been pretty. So let's take a look at the weekly candle. 2 weeks in a row. 2 weeks of pretty aggressive selling. From high to low for the week, it's down 162 points, which is, again, beyond the expected move. Time will tell. Right? Okay, so I got to keep an eye on that one. Come on, baby. Give me 10 points to the upside. Let's try to tag 5,900 before we're done today. Try to get this thing out of some trouble. And then I'll take a winner in that 45-cent credit spread. Just don't close red all day. That's all I'm asking for. It's been red for like 8 or 9 candles in a row. Give me one decent green candle, right? One green candle. Problem is, it's right in the middle of all this crap where we might have to come back down to touch like 58.50. I don't know. That's the hard part about trying to pick tops and bottoms for the day. If it works, it works. If it doesn't, it doesn't. So we'll see. Hopefully there's a stickiness at 5,900 to draw price back to it. All right, let's talk some other stuff. I'll keep an eye on that. I got to keep spot checking that. Trying to think. Bar counts, most important thing for me right now, just bracing for some more. This is why I have the hedges on. Probably the best decision I made in the last 30 days is selling these tops. All I did was buy a put and then sold a put down here near the 200 moving average. A lot of these trades, on average, cost me about $500, and they pay out about $2,500. Now, I don't need to necessarily make all $2,500. Obviously, that'd be great, but that's my max profit if I take it all the way to expiration. So if this hits my target, then instead of closing out for a full profit earlier than expiration, would probably offer me maybe $1,700, $1,800, $1,900. It just depends on what it looks like, but this is part of the reason I'm going to keep those hedges running. So, because I guess on the hedge side, it's like, am I willing to sacrifice some hedges if the market like bounces really aggressively? Sure. It'd be frustrating to have like $12,000 in hedges right now, but if this goes down, that's probably going to be close to $20,000 in hedges, which I think is important, as opposed to if it pops back up here, I'll lose $500 and the rest of my portfolio is right back where I want it to be. So that's the trade-off is, yes, as much as I'd like to take some profit on some of these hedges right now, I still have, more downside that I need to be braced for just in case. because the reward to risk on those are just they're so solid. All right, anyway, that's where we're at. Nasdaq dropping like it's hot. We could have this election gap filled on the Nasdaq. Find the 200 moving average. This area out here. I mean, just zoom out. This is what's kind of crazy. The Nasdaq. I'm just going to use a big fat marker here, but between this 200 moving average, and support, this is a large area to look to see if the market's going to bounce, right? So I mean, the 200 could be a spot to nibble, but we could have a ugly correction. And do I think that, this is like the classic saying, like, buy when others are fearful? I mean, if the Nasdaq is down 15, 16%, I'm going to be buying it. Okay. And I'm sure smart money is going to be buying it too. It's not going to be fun. It's going to feel like garbage to jump in and basically, either you can buy and take a bite at it, or you can just sell a ton of premium because implied volatility is going to be excessively high. So even some, out of the money puts would work out pretty well. Some, bull call spreads, like there could be a lot of easy trades to take. It's just keep an eye on these levels. We are creeping into this 144 now. We're dumping a little bit harder. We're down to some fresh lows. Come on, dude. 30 freaking minutes. I need 10 to 15 points. 10 to 15 points in 30 minutes to the upside. Give it to me. Qs are down towards the 144. S&P at fresh lows today. This is down almost to the 144. SPY pretty much the same through the 100 coming into that 144. The Dow is another one that I'm going to be watching closely. I think the Dow looks pretty good for a potential, bounce in here. But again, I'll use the big marker. This is a level to watch between this 200 moving average and this support, right? So 420 to 400 on the DIA. I know that's a big area, right? That's almost a 5% buffer. 420 to 400, it's about a 5% area. So would I obviously like to call the bottom? Of course I would, but that's silly. So we either have support in here that holds, okay, and this is nothing but sideways price action, or this is going to be a dump to find some support, and then we have to have some type of cup and handle reversal where it comes back up and fights its way back. Okay, the issue going on right now is the market is not loving the initial policy of the Trump administration, because everyone was expecting deregulation, pro-capitalism, tax cuts, but what have we led with instead? We led with tariffs and geopolitical tension, right? Massive deportation. We led with federal layoffs, which is now translated into tech. Tech has been laying off people since last quarter. It's kind of this like hidden thing that's happening, but tech's laying off people left and right. It's starting to translate into like Starbucks is laying off people. So there's definitely some bracing for a slowdown. On top of that, we've had high inflation readings. The Fed's not going to do anything other than stay restrictive. It's not looking good, but I still think there's a lot of resiliency in the market. I truly do. I just think that right now, this is why it feels so rough when it's like everything's down 5 or 6 days in a row. But I mean, here's a good example as far as reading this. So, let's go. The Fed. So the tariffs and immigration restrictions were put in first, right? So what does this do? This is creating supply chain uncertainty. It's tightening the labor market. You're pushing inflation higher. And this is all putting this stuff. So we put in tariffs and immigration restrictions and layoffs before we started to implement tax cuts and deregulation. This is what everyone was excited about in Q4. Trump's coming in, deregulation, tax cuts, pro-capitalism. But what do we lead with? Tariffs, right? Like ugly stuff that's it's the chainsaw. That's your Elon Musk analogy, right? So anyway, this is why the market's not really loving it. Inflation's not really getting any better. The 2 to 3% target, or the 2% target, is way off. It's light years away for the Fed right now. And I think the reality is, if the Fed doesn't want to look like fools, then what they should do, and I don't know if the market's going to like this either, but they should talk about the more modern economy allows for a 2 to 3% inflation window, as opposed to if the market's holding them accountable for trying to get back to 2%. The only way we get back to 2% is probably cutting rates, or sorry, I'm sorry, raising rates, and like running the risk of like crashing the markets. That's the one way I could see the Fed really fudging everything up. You know, so I don't think they're going to do that. I don't think they're going to raise rates necessarily because they don't want to. But anyway, I just think that the priority is everyone thought deregulation, tax cuts, which is positive, but instead it's led with the wrong thing. So sequence-wise, was led the wrong way, and this is what the market is not loving. And here we go. So this is what it looks like. It all translates into some timing that I was watching for the last 30 to 60 days, and now the timing is working out. I'm still fighting, some drawdowns as far as my positioning goes, but I also have some really nice hedges to offset a lot of that. So it's okay. I just don't want to see this. If we go high, low, lower high, lower low, that's where I'm going to put the brakes on this entire idea of a bull market. Okay. I think a bull market that is going to have some type of bounce, it almost has to overshoot first, and then we'll see if the market is going to bounce. Okay. Or overshoot first, flush down one more time as a manipulation trade, and then reverse. Right. It could be right around or right through that 200 moving average. I'm just calling out some big levels here. So if I go into this, I've had this analysis up for months now, but look at this big fat area, right? Use this. Major support, major support, major support, and the dynamic 200 moving average, right? So 5,700 to 5,500, that's a big area. That's a 200-point area, but that's where I could see the market likely showing signs of bouncing. Okay, 58.86. Let's go, 9 points. Come on, baby. Take a look at this right now. Damn, man. 745 debit. This thing's brutal. Let's go green. I don't know. This is gonna be a tough one. I've got 26 minutes. So if I take it on the chin right now, the 50-cent credit closes for, well, on a positive side. Here's how the math is going to work. I'll keep an eye on this one. The math will work this way. So I've got 59.05 to 5,900. That to me is worth $500. Okay, and then from 5,900 down to 58.80, that is worth $2K. Okay, so the most I can lose on this trade is $1,450. That's the most I can lose. So even if the market plummets today, that's my loss. Does it suck? Yes. Am I happy? No. Can I survive and trade it again? Sure. I've got about a $600 hedge running right now. That's upwards of $1,500, so I can wash a lot of that. I'd love to see the market jump up here in the next 25 minutes and try to sneak up towards 58.95 or 5,900. That'd be nice. I don't often ask the market to do things because I know that doesn't do anything. But if it were to happen, I wouldn't be upset. But anyway, that's the worst that can happen on this trade. So I do have a profit trap. I am risking about 2K. My net risk would be about 1450, and that will cash settle. So if we close today at 58.90, okay, then I get my $500 profit trap, and then I'm losing $500 here. So I'm going to wash this trade. So at 58.90, that is my risk. That's where I'm eating the amount. So anyway, that's what I've got to watch till closing bell. DXY strong today. Yeah, I know. I mean, the dollar's been bid pretty nicely. I'm not surprised. I mean, look, the dollar index to me was a 106, 105.50 support zone. Dollar's getting pretty strong. Currency strength on the day. It's all dollar today. I'm really surprised that the Swiss and yen haven't shown up at in any way, shape, or form for some type of risk-off trade. It's all dollar today. So I thought that was interesting, like the dollar's bid. I don't know if this is a little glance at higher inflation, if this is a glance of dollar staying bid, if this is a glance of risk off that's helping the dollar. I know the dollar going up is also going to bring gold lower. Gold is another one with a really high bar count that I know everyone's been in gold and been loving gold, and everyone wants to know when they can buy the dip on gold. But gold has a 354 bar count. In addition to that, it has a monster percentage where we are around 12% away from the moving average. If you go back historically, you don't see a lot of stretch away moves without going sideways. This high here was stretched away around 15%, and we went dead sideways for months. This move here, similar, right? And we had a pullback. So that was back around 13, 14%. We pulled back. Same thing here, just another chunk, 12, 13%. Are we going to go sideways or pull back? On top of that, you look at some wave structure. There's definitely what looks to be a 5-wave structure here. 1, 2, 3, 4, and 5, right? And I think at the very least, we're going to have like an A, B, C or pullback that comes into. I'd like to see gold pull back to like 2,600, 2,500 before I want to resume long positions. So I'm not jumping in early, but SPX daily RSI at 35. You figure the end. It's close-ish. Okay, I think we could have a capitulation move though. Just I'm not that eager to call the bottom, but if I have one more workspace here, there's one that I have harmonics and pivots with some momentum oscillators. So let's go here. So you're telling me SPX on the daily? Nope, it's not that close, to be honest. I looked at this week. I've got RSI, which my calculated RSI is a 21 period. So if you're using like a 14 period, that's going to get hit a lot faster, right? That's going to get hit a lot faster than a 21. This is what I've used this for a long time. A 21 period rarely gets overbought or oversold, and that's why I tend to use it. So I think that there's still more downside towards the 144 200 moving average. I would like to see, and the other thing here, if I use the 21 period RSI, very rarely does it actually get to 30. Right? A good buying opportunity for the last several years has been when this thing is at 40 or lower. So I'll go ahead and just set a chart alarm here. Hopefully I have one to spare. I'm going to set a chart alarm at, these are all in the 30 somethings. I'll go chart alarm around 37 or 38. So value be 38. See if we can get 30. I'll put it at 40 actually. I'll put it at 40 first and see what that looks like. Okay, but gold has a bar count. I literally mentioned all this in my Telegram video. Gold has a bar count, index-wise. S&P has a bar count. NASDAQ has a bar count. Dow has a bar count. The Russell keeps bouncing off the 200 moving average, but now it's below it. Now we're quite a bit below the 200. This is that window that I'm talking about. Okay, look at the Russell here. See these big areas? There's 1, there's 2, there's 3. Here's the 200. But that's technical structure, right? 1, 2, 3. This could be support. But it's got to bounce, right? I mean, the nice thing on the Russell is this previous resistance could offer some really good support, but man, Russell could get nasty, right? Like we could go from 212 down to 200, and that would be a pretty big sell-off. Pretty big sell-off. So high to low, that'd be an 18, almost 19% sell-off in the Russell. That's pretty aggressive. Okay. Well, we got 20 minutes left. I'm begging for about 20 points to the upside. Not looking good, everybody. That broken wing might be a little 1450 loss today. So the question now is, do I want to close out a hedge to offset the entire thing, or am I going to let the hedges continue to do work? So right now, hedge up around 570 bucks. That washes a little bit of that way away. Let's see here. Broken wing butterfly, that's down $1,000 right now. Yuck. This one is up 370 bucks. This one's up 817. I mean, if I close all my hedges right now, I'm basically flat. Well, a little bit more. I've got trying to think here. I've got SPY hedge. I can carve out some profit. I've got about $570 in SPS hedge, 375, 805. That's 1750 on a max loss of 1405. That's not bad. So I could just get rid of it. End up finishing about $350 positive. Wouldn't be awful. But then I'm less braced to the downside here. So this one, yeah. I mean, these are futures trades. If I want to close these, I can close these after bell. I'm just thinking on this SPY position, 586. Oh, this market is just hemorrhaging today. Down over 2% high to low. NASDAQ's down over 2% for the day. It's probably had an even bigger swing. NASDAQ from top to bottom is pushing 3.33%. Dow only showing 0.4%, but it's probably had over a 1% swing. That's over 1.5% from top to bottom. Russell, bunch of noise this morning, big old shakeout, still down almost 2%. So yeah, we are falling and falling hard. But like I said, it's been part of the technical plan for the last 60 days. The hard part is it feels shitty. It really does. You know, having 6 days in a row and it's like there's nowhere to hide. Seems like it at least. I mean, okay, so I've got some hedges. Okay, fine. It's just like offsetting some of the red. But it doesn't feel good. You know, what I need to do is just be patient, try to get some of my levels. The trade-off right now, this is what I'm debating in the next like 17 minutes. Do I close out my hedges, wash away that broken wing butterfly that's not looking great right now? I literally need like a 18 to 20 point miracle just to get that one back into a profit trap, or at least, you know, be down like nothing. I don't know if that's going to happen. That's a immaculate reception towards the end of the close today for the next 16 minutes. I don't trade on hope, so I don't think it's going to happen. But I can let the broken wing cash settle. I can close out some hedges, take my position off. So this trade is fine. This one's fine. And actually, this profit trap might actually work out to be to my benefit. This one actually might be even better. $7. That one's fine. This one, as an $800 hedge, this one's looking pretty good. So I might just take the profit here. See if I can close this one out. So I got in for 143. I'm going to close this at 265. $262. All right, just close it out for 260. So that was a hedge that closed out for 260. So let's do the math on that. 260 minus 143. That's a $585 winner. Okay, so I closed out that one for 585. This one is still in some profit. I'm going to let that one run a little bit longer. This is a bear put spread that's showing about $500 of profit right now. Net wise, it's up about $230. So I'm going to let that one continue to dance around a little bit longer. And then my SPY hedge right here, this one is up 572. Let me see what I can close this one out at. So we're trading at 585, 1058. See if I can get to 1070 maybe. $1065 not filling. Let's go 1060. I mean, the mid price. Come on, dude. 1055. Fill the 1055. Okay, so that was a 475 hedge. 475 hedge. Close it out for 1055. That's a 95% gain on that hedge. I will take it. So it's fair to offset a little bit. So that was 1055 minus 475. It's $580 on the $500+ on the ES hedge. Okay, so it's workable. Not fun, not pleasant, I need a 13-minute miracle here to get back to 58.95, 5900. It's unlikely, which is why I'm just going to offset it with some of those hedges. I still have some other hedges running. So this one on MES, this one is running. I'm going to let this one continue to work. That one's trading the MES both ways. So my 61.75 to 5700, there's still another couple hundred points of that one. This one could max out around, trying to think, I could max this one around $2,000. So I'll keep a close eye on that one. This one is an income trade. This one's out to March 7th. So this is next Friday. Probably going to finish for full profit here. Come on, Bulls. 12 minutes. Let's go. Show up. Let's get a little miracle. Let's get a little miracle Hail Mary 20-point move, shall we? I've got the chart alarm set at 5,900. I'm going to edit this to 58.95. If that activates, then I'm getting out of that little broken wing unscathed. Oops, I meant 58.95. All right, so that is unscathed broken wing. If it doesn't activate, then I'm taking some heat. I'll do the math. If it's below 58.80, then I'm taking the full 1450 loss. Okay, yeah, everything's down. I get it. Everything is down. So I will say this for the end of the month for February, right? End of the month will be important. Tomorrow's going to be honestly, just for sentiment purposes, tomorrow's going to be a pretty key day, because if tomorrow is another flush lower, then this pain is not done until probably we hit that 200 moving average or beyond. Okay. We start a fresh month of trading next week. A lot of the earnings plays are done. Nvidia didn't really do anything to save the market. It just continued to fade again. So everything's down, right? Everything's down. Like I said, if tomorrow it shows like the bleeding can stop, I do think there's a chance that the bulls can somewhat step in here. Like, this is a big gap fill, So if the market wanted to validate this and then use this as support, then sure, bulls break this area, right side of the trend line, we come back and maybe make a run. Now, in a way, it's like that would feel a lot better to see some green, but it still doesn't solve the bar counts that I've been watching for the last I'd say the last like 60 to 90 days. I still think these bar counts have to get hit. So I still think this market needs to find it. So even a move to the upside is like a dead cat bounce. It'll feel better, but I think even a pullback, having 6 candles in a row, for example, even a pullback probably gets faded. So just be prepared for probably not going to be a lot of fun through March. So either get it over with, brace the pain. It's going to suck. But once we bounce and get it over with, then, okay, things look a little bit better. Things look a little bit better. All right. Yep, I saw that, Jonathan. He's been a net seller since Q3. They have one of the biggest stockpiles that they've ever had at Berkshire Hathaway. And all it is everything they've had has just been, to their framework, overvalued. And so now they're sitting on a crap ton of cash. And Buffett can do exactly what he says: buy when others are fearful. So they're going to look at everything across the board, and they'll have they'll be pushing the cart down every aisle and just picking up things on sale. And that's why Buffett, it's funny, like, everyone loves him, respects him, but nobody does what he does, right? When the guy's been net seller since Q3, nobody started selling stocks. Everyone's criticizing him for like, oh, he's missing out. Look at how much the market went up after the election. Yeah, but look at him now. I mean, Berkshire's at all-time highs, and they're sitting on like 20% of assets in cash, getting about 4 to 4.3%. If worse comes to worse, they're still getting about 4% on their cash, without having a ton of exposure. So, all right, we've got about 9 minutes left. Let me take a quick peek at this butterfly just to see if there's anything here at the very end of the day. These bear call spreads are going to be profitable. This is going to be a full like 45 or 50 cents for the end of the day. I'll let that cash settle. This one, take a peek. All right. So I'm obviously not going to close it at $11. Worst case, this can close out at $15. That's my worst. I'm not going to close it. Like, it'll cash settle. My risk is defined. We're all the way down to 58.76. Yikes. All right. We need like a miracle 10 minutes here. So, I do have a decent amount of cash. I mean, I've got about 33% cash in my portfolio. It's not bad. I mean, it's more than Buffett. he has he has about 18 to 20% of Berkshire's in cash. But obviously, 3 million is a lot different than 334 billion. But yeah, I mean, percentage wise, like I've got some cash. I will be watching. So, all right, broken wing, not looking good. 7 minutes to go. It's already defined. It can't get any worse. If it loses, it's going to be a 1450 loser. That'll suck. But hedges are still going. Here's my hedge on MES. So this one down to 5,700, and that would allow this trade to give me. Let me try to calculate some max profit here. So if I get down to, that's a 475. That's a 2375 hedge. So let's say I take 475 minus I'll do the numbers on this really quickly. So 40.75 minus 135.50 minus 143 plus 50. So 187.50 is that trade. Make sure that's right. So those are the four that I need. 187.50. Okay. So if I close out for 475 minus 187.50 times 5. So it's a 1437 hedge. It's up about $200. So I still have some more profit potential in this one. So that hedge is still fine. That'll help alleviate some of the pain. That's what I'll keep running with. My other accounts that are the 0.25 and 0.5% risk, I'm going to keep those hedges alive and running a little bit. So I closed out some of the hedges to offset that broken wing today. I'm going to have the other hedges in the portfolio in case they get worse. That'll be about 25 grand, 30 grand in hedge protection, which helps a lot. But we're sitting here at some lows. Yuck. What a freaking week, huh? 2 weeks in a row. Nasty, nastier, and a lot of chop. But directionally, man, not super surprised. It just is ugly. Like I probably overtraded today. I tried to call a bottom, and as Confucius say, sometimes when you pick your bottom, you have smelly fingers. So don't do it. But I did, and I'm paying for it. That's what happens. All right. So we'll see. But as we wrap up today, and the market stops and halts or whatever, it's not halting, but as the market just kind of stops and figures out what's it going to do tomorrow to end the month, tomorrow will be a pretty important day just to see how bearish is the sentiment become. If everyone is running for the hills and we clear this level and we come after this level, then I'm pretty confident we are just going right after that 200 moving average with some velocity. So as I wrap things up here for the final hour, just be mindful of this. This is a good level, okay? It doesn't mean it's the bottom. So just be aware that if we do some technical analysis based on this April, this is good structure. April of 2024, August of 2024, that's the window that I would say if I'm really going to be guessing at a bottom, it would be between the 200 moving average and that technical support. It'd be that area. Okay, so option trades over 30 to 60 to 90 days, I think could carve out a bottom. Right? That's the beautiful thing about trading options. A simple bull call spread, waterfall income would be beautiful for this area, which is what we'll end up doing. Okay, so I just want to be patient for that. I've got some profit traps as well. Like there's all sorts of stuff going on here, but it looks like if tomorrow doesn't end up giving us something like this tomorrow, then we're going to come in and sweep this low. We're going to come in and probably just fall with a lot of velocity. And that's why I don't think I want to call in and step in the way of this falling knife and say like, well, I thought it bounced off the 200 moving average. Well, if it doesn't, then that would be my bounce. and we all have to realize like this could get very ugly. This could be a 200 moving average that goes down through it, pauses at it, flushes down again, and then reverses. So I just if you're going to put a lot of pain in this market right now, then look at the 10 to 15% correction zone. That's going to be painful, especially if that is happening within like let's say we get like 9 or 10 candles in a row. That's a monster sell-off, right? It might be overcooked, it might be overdone, but if it happens, if we get a double-digit correction within a short amount of time, man, we're going to have to see where this market is made of. Like resiliency-wise, it might be like, where are the bulls? Where are they? Because we are just sliding lower and lower and lower all day, and that trade sucks, right? Like this thing is down 4.6% in the last 2 weeks. That's a lot of selling. Let's just take it out a month. Well, if we went out 9.2% and we did it in the last month, like that's a pretty healthy correction. So what is this? That's a 6% correction. So I don't know. Let me just get a pulse out there. How many of us think? And I'll just it's no there's no right or wrong answer here. How many of us think we're going to get a double-digit correction? Type in 10 plus. Type in 10 plus in the chat if you think we're going to get a double-digit correction. Or type in, less than 10 if you think we're going to get less than 10%. 10% is a big one. 10% would be in this area. This would be shooting through the 200 moving average, going down into this April, August, and this correction zone. That would be like that 10 to 11% correction in the S&P. I can see it happening. Just want to be ready for it, right? NASDAQ, same structure. Look at how much further this one could go. April to August, look at how much further this one could go. This could be a correction in the 15 to 16% area. Just saying. 10 plus percent in the S&P, 15% or so in the NASDAQ. Could be ugly. Okay. All right. Chart alarm off here. Relative strength at 21, crossing 40. Really? Well, that was quick. Just like that. Well, we got 40. Let me set another chart alarm here at 30. I'm going to go 37. Anytime I've seen like 37 readings in here, that's a pretty good buying opportunity. And there's the close. There's the close. All right. So alert at 37. And we'll see if that activates. We've seen lower, like this low here is around 33.50, lows around 33.50. That to me would be like, okay, I'm going to check end of day, see what the calculation is. If we're at 34, 33, I'm probably just going to take some exposure. Okay. But doesn't feel good. But where are we going? Okay. Tomorrow is going to be an important close. Right? Why is tomorrow important close? Because if there's any sign of the bulls, it just stops the velocity we've seen for the last 6 days. It's ugly. 6 days of selling doesn't feel good. If the market pauses for a second, at least it shows us that there are some bulls in the market. But again, it makes me a little bit more hesitant to call that 200, and we could be, slapping in some capitulation moves down even another 5% beyond. And that's where it's going to get really crazy. RSI, yeah, they're all 21 period. On the daily chart, they're all 21 periods. Yep. It's just this workspace that I have. This one I've done the 21 period. I've used that for a long time. And that way I stay out of like the 14 gets oversold, overbought quite a bit. If I change this right now, if I change this to a 14, you're going to see that thing exceeding the top and bottom quite a lot. Right? So now, we've actually had quite a bit of like oversold conditions. Right? So, I mean, getting down towards 30, it's getting closer, but I think the 21 over what I've used in the past, it's like I don't really have to pay attention to it until I think it is a bigger deal. If we're oversold here, overbought here, I tend to pay a lot closer attention to it because it's harder to get to. Interesting. Crude is way up, is it? I mean, it's up 2%, but it's been getting its face slapped in since February. mean, that's just a lot of chop, and I don't know. I'm not really taking anything with oil right now. I would still be considered a long oil trader in here, or waiting for structure to I don't know, bottom out or break or bounce or something. But I'd rather just buy it off the lows. Okay. Depends on my bottom and top or 2080. I mean, that's fine if you're only really looking to dip in at 20. If it's low 20 on RSI, like that's a different reading. But typically it's 70/30, which is why I keep that 21 period. All right, NG down, gold down, silver down. Let's just take a look at everything today. How about we see what the heat map looks like? Because I'm sure that's awesome. Puke, right? And this is why I'm saying, like, this is a aggressive rotation. What is a rotation? Well, get out of here. So rotation is, so this is rotation. We are exiting Mag 7, okay? Which doesn't mean that Mag 7 is a bad play. It just means like these things have to correct. And they are correcting. And because it was such a, concentration in them, that rotation out, it has to go somewhere. So exiting Mag 7 and going into where? So we're exiting Mag 7, you're exiting growth and momentum, right? So what you're doing is you're rotating rotation to value, low beta, defensives. Okay, so you're probably looking at like staples, you're looking at financials, you're looking at industrials, maybe some materials, you're looking at energy. That's where money's going. Okay, so the tricky part is just because you rotate into those things does not mean you have gains. This could go from, what was an outperformer to a terrible performer. And if you rotate out of it, it just means that you rotate into something that doesn't suck as bad, right? Example being like if Mag 7 as a whole is down, 10, 15%, index as a whole are down 10, 15%. Individual stocks in that space of growth momentum, your Carvanas, your Palantirs, your Snowflakes, your AVGOs, your semiconductor space in general, any of those that have just been like, oh my God, the stock's up 100+%. Those stocks are at risk. Those are the stocks that could have the 20, 30, 40, 50% corrections. And I don't want to touch any of those. Because if you're calling a bottom on those, I mean, those are the stocks that if we have a really nasty environment, those stocks could be down 60, 70, 80, 90%. And if you allocate too much, you will wait for years to get back that money. And at some point, I just think it becomes dead capital. So I'm really trying to stick to, I like lower beta. So this is what I'm looking for. I'll watch for my 200 EMA and then the connection of April to August lows and connect the dots. Okay, that would be my kind of area support. Now I can also rotate away from the large cap market cap weighted, so I can rotate from SPY, go into RSP. I can rotate out of Q. My keyboard just die. Weird. From QQQQ, I can rotate into QQQE. From IWM, I could rotate to IWX. I could also rotate to the Dow. Right? SPY's had a good run, but if equal weight is a lesser suck, I'd rather rotate to equal weight. If you rotate equal weight and it doesn't go down as badly, I'd rather rotate there. So these are ways to play. I think you're going to have some support zones, right? So exactly right. Yep. If you go minus Mag 7, so you've got a rotation into like 490 stocks. Now that's still a broad market, right? The issue is, it's like if you're trying to be an individual stock picker in that broad market, I mean, what's performing well? Insurance, crushing it right now. Healthcare, crushing it right now. I mean, what does Berkshire have? They've got a lot of insurance plays. Financial services, Mastercard. I mean, consumers are living off credit. We've got student loan debts. We have consumer credit card debts that's over $1 trillion with delinquencies on the rise. You've got some red sprinkled in all over the place, but what is leading the dump? Mag 7, baby. Amazon down, Tesla down, Google down, Meta down, Apple down, Nvidia down, Microsoft down, AVGO, which is now your Mag 8, if you want to throw that in, since it's $1 trillion stock. And they're dumping. That's dragging the market with it. So, here's I don't know. I don't know how everybody feels out there. It doesn't feel great, right? I ended up basically washing a $1,500 loss today and closed out my hedges early just because I'm like, well, I'm gonna get out of these hedges. I still have one left that's still offering up a couple $1,000s, so that's fine. But I'm washing that day trade that sucked today. That broken wing, good intention, bad result. And what the market ended up doing from a percentage standpoint, I think we went top to bottom over 2%. Top to bottom today was probably over 2% slide. Market went 2.27% from top to bottom. That's a lot. That's pretty unusual, So what I thought was a pretty safe play of like, all right, let's put this thing around, I don't know, maybe 90 to 100 points. Average move is about 70. Nope, it slid further. So I got burned on that broken wing butterfly. That stings. But hedge wise, I offset a lot of it. In fact, I offset like all of it. But it doesn't matter. It's still a sucky trade. Okay, jobless was bad today. Yeah, it was jobless claims, right? Jobless claims 242. Revision was about the same. So, yeah, look, when it rains, it pours. It's nothing about this slide is going to feel good. Okay, I can promise you that nothing about this is going to feel good, other than if you survive it, there's good opportunities. Okay, now I don't want to end this on a sour note, but I will say this can get a lot worse and a lot scarier all the way down to this blue line. This is going to be my biggest concern for 2025 into 2026. This is a 5-period yearly moving average. 5-period yearly moving average. Why does that matter? Zoom out for a second and see how often this thing gets hit. Not very often. But when we do stretch away from 2012 to 2015, we do end up coming back to it. Stretch away from 2016 to 2018, we come back to it. 2018 to 2020, we come back to it. 2020 to 2022, we come back to it. 2022 to now 2025, that's not good, right? If this market really puts in a top here, we could be bracing for some crap. That's bear market. So could it happen? Maybe. I still think it's a great buying opportunity, but you got to stay solvent. If we can't take some nibbles in here and get paid on it, then this is going to be defined risk. It's got to be defined risk, because if it's not, this area, I've got to have cash at the ready. I got to maintain. If I got that 30% cash, I got to maintain as much of that as I can. So I've got to look to aggressively rotate, maybe continue to hedge. It's going to be a necessary evil. So all right. So again, I'm only doing this to put it on the radar. I'm not doing this to scare anybody. I'm doing this to be really honest about where I think the market, like that's kind of worst case scenario in my opinion. If we're going to find this 5-period moving average, I'll say that we talked about it February 27th. It's been on my radar since the start of 2025. I don't think the market's going to be that bearish. I don't think a rotation on a Mag 7 means that this market can't stop the bleeding and hemorrhaging and find a way to cut back. But what we need to see, is there's too much going on right now with tariffs and geopolitical tension and layoffs, right? So you have a tighter labor market, which is not good. Actually, I would say a loosening labor market. Okay. We got geopolitical tension, tariffs. This is what we led with in 2025. Instead of what does the market want? Market wants more rate cuts from the Fed, and it wants tax cuts, and it wants deregulation. Okay. This is what the market wants. This is what it's not getting. Not yet. This is part of policy. We're just not there yet. What the market get? We got a big fat turd sandwich full of tariffs and layoffs. This is why it's not good. So the rotation away from what's been working and working probably too well. I mean, nobody should be surprised that the markets are leaving Mag 7. When Apple was a value stock at 8 times multiple and now it's trading for 40 times multiple, it's no longer a value stock. It's a growth stock. It's a big tech stock. I still think Apple's a great company. I still think they're going to have crazy amounts of cash and margins to do whatever they want. But the stock market prices things out how they want, and it'll price things in. The pendulum swings one way and it swings the other way. So all this stuff we have to just try to survive. It's not going to be fun, right? So does it get that bad? I don't think so necessarily. But to me, this plan would be more of like, okay, let's say the market survives, and it's a really ugly 2025. Okay. This blue line, I think, comes in play into 2026. If we survive that type of cleanse through this year, I think 2026, this gets hit. I'm a little bit more bearish in 2026. Now, I'd like to think that timing would be okay. We've had 20%. So 2023 was a 20% year in the index, right? This is S&P. 2024 was a 20% year in the index. Anytime that's happened in the past, the third year has typically produced an average of 11 to 12% gains. Well, if we're going to see 10% this year, 11% this year, so far it's not been an easy path forward, right? Now the market's ready for the year. So it's an uphill battle to get there. But can we do it? Maybe. Maybe, But I just want you to be aware that, okay, 200 moving average, okay, fine. April, August support levels, okay, fine. If it bounces, hooray. If it doesn't, well, there's a massive buying opportunity down here, and that's about 20%. So either we're doing a 7 to 10% correction. If we overshoot, maybe a 10 to 15, depending on the index. But if it gets really crappy out there, we're going, bear market. By the time this market all of a sudden hits a bear market, I think I would be eager to buy that dip. But it will not be fun, whatever happens. So time will tell. Seasonality wise, another thing for the months, we can look at this for market seasonality. Oh yeah. Seasonality month to month. Okay, so over a 10-year average, I mean, September, October are the worst months over the last 10 years. Historically speaking, September is still like one of the worst months. March is no picnic, though. March usually produces some pretty crappy gains. So if we have this cycle from now until March, this market might be in correction mode until it kind of rights the ship in April. If April and May come back in a big way, then it'd be nice to kind of pick up the slack and see like April, May into the summer can kind of correct and fix. If March gets worse, then we're fingers crossed that April through August is going to be a little bit of a pickup. Okay, so just don't be silly aggressive. Keep the trade size small. Market's going to be the market. Hedges aren't bad. I'm still holding hedges with intention. Like there's still room to run. I want to be hedging for that reason. And I mean, honestly, it's like if it doesn't stop at the 200, then I get kind of excess profits in here. But a lot of those, it's like it's capped. But I know my cap. It's like I'm risking $500 to make about $2,500. If I do that on 4 hedges, I'm risking about $2,000 to make $10,000, and I do that on 11 accounts. I mean, that's not bad. I mean, I could have six figures in hedges. So it's not going to be perfect. I'm not offsetting all of my positions, so I could be red, but instead of being down, 100 grand in drawdowns, I could actually offset a lot of that. So maybe if I'm lucky, I can offset what would be, 100 grand in drawdowns could be maybe 20 grand in drawdowns, 30 grand in drawdowns, and I could keep it pretty tight. Oh, that's gold. Oh, my bad. I want to go S&P. Yeah, thanks. S&P here. There you go. Okay. Yeah, interesting. Yowza. Yeah. So this is S&P seasonality. But the nice thing is, I mean, eventually, I just don't think the market implodes all year. Obviously, I think there's good dynamic support. If February kind of stops the bleeding and March can stabilize, April and May, I would say April, May into August could be the recovery. You know, so if you can look out for at least a 2 to 3 month horizon, don't do anything stupid. Don't overextend yourself. I think this market can resolve a lot of things. It might offer some really good discounts, and even in the near term, like I wouldn't necessarily be positioning for like these big yearly runs. If this market falls into this area, let me use a different color here. If this market falls into this area, this could be our like April, May, June, July, and then August, maybe. I mean, do we get back to all-time highs through the fall? I don't know. But February, March right now, lining up for bears have the momentum. There's clearly an aggressive rotation away out of growth momentum, out of Mag 7. Market's concerned. I get it. It's all the bad news coming at once, and it just feels like a landslide of crap. But there are some technical levels to be very mindful of, and I think there's appropriate times to play it. And we'll find out. So, all right. That being said, I'm gonna let you go. Let's come back and do this again tomorrow. It's been a day, so I'm ready to disconnect from the market for a little bit. Come back and scratch again tomorrow. All right. Bitcoin. Yeah, I mean everything's down, right? What's Bitcoin at? I mean, Bitcoin's hanging in there. Surprisingly, like markets being down, we've had 3 nasty days of Bitcoin. It's pausing. It could get worse. I don't know. Bitcoin's got a pretty aggressive bounce off this 74K level if it finds it. So I think there's an opportunity here as well. Past resistance to become support. Look for that bounce there. MicroStrategy at 240. It's sliding a little bit lower. I've got my puts on. So if the puts come down into like the low 200s, I'm just going to keep lowering my cost basis. So, all right, sounds good. I'll see you tomorrow. Thanks, everybody. Bye.